Hi, everyone. Welcome back. The latest Gate Pass Market Monday is here. September continues to buck the trend of seasonality, with the S&P 500 notching its 42nd new high of the year this past week. Given we are recording this on the last day of the month and barring no catastrophic decline today, September's on pace to mark the first 8 of 9 months of this year being positive. And with the new quarter starting tomorrow, seasonality shifts back into our favor. Going all the way back to post-World War II, on average, the fourth quarter has been the strongest quarter, being positive 78% of the time. Now, unfortunately, we know the market just doesn't go up and to the right. It's just not how this works, right? So it's worth noting that October is also the most volatile month of the year. And by volatile, we mean swings to the upside and swings to the downside, not just being in the red. And it's typically more exacerbated in election years as well. So what we historically have seen is October be pretty choppy, and then things start to settle down once a new president is elected. And then November and December are pretty strong months. And then to throw on top of it, earnings season kicks off middle of the month as well, which could cause some more added volatility. Now, if you're with us last week, we dove deep into the rate cut cycle. If you missed it, feel free to watch last week's episode or listen to it. But one thing that's worth mentioning for our purposes is that when the Federal Reserve does a rate cut cycle, when the S&P 500 is at or near all-time highs, that typically is a very good sign for long-term investors. Bloomberg had a very interesting data point. So going all the way back to 1980, there's been 20 instances where the S&P 500 was either trading at or near all-time highs, and all 20 out of 20 times, the forward 12-month return was positive for the S&P 500. And we all know households don't borrow off the Fed funds rate, right? Financial conditions in the marketplace are what really matters. And as the Fed starts this easing cycle, there should be instantaneous relief on mortgage rates, home equity line of credits, auto loans, small business loans that could spur both economic and business growth for the economy. And so why is that so important? At the end of the day, it's all about the consumer, right? The consumer accounts for 68% of GDP. So a little over 2/3 of the GDP of the United States is dependent on the consumer. The consumers are the engine that powers the US economy. And right now, consumers are sitting on trillions of cash. And as interest rates start to ease off, this could fuel some credit growth to really be the next leg for the economy right now. So there's a lot of positives right now with the rate cycle, but it's not without any risk, right? And so right now, the biggest risk for Jerome Powell and his team are cutting rates too much, too quickly, and then overheating the economy that could start to pressure the consumer. So we had one rate cut. There's a lot more data points that are going to be coming out. So we're still very early on, but we think if the consumer is minimally or not affected at all, the Federal Reserve will be able to thread the needle on some type of soft landing or no landing at all. And we really could avert a major economic meltdown. But like we said, there's a lot more data points that we're tracking before the November next Fed meeting. So we will be paying very close attention to that, and we'll be keeping you updated weekly as we start to get a lot more of those data points as well. That's all we have for you for this week. Thanks for tuning in, and we'll see everyone next week.